Hi, today I'll be giving you the rundown on the basics of financial accounting principles. So accounting is actually just a system of dealing with financial data that provides information for decision making. Kind of like when you look at your bank account to figure out what you can or can't buy. Activities involving accounting include gathering financial information, preparing and collecting records, rearranging and organizing information into easily accessible form, as well as preparing informational reports and summaries. Or you could just remember all of that by thinking of accounting as a real-life game of Monopoly. Except you track down every transaction, including purchases or sales. Here we'll take a look at some examples of businesses and business ownership types. The four businesses that we will look at consist of servicing, manufacturing, merchandising, and nonprofit. Additionally, the forms of business ownership that usually accompany these four types of businesses are sole proprietorship, partnership, limited company, and corporation. Now let's go over some accounting principles and standards. The business entity concept is generally the rule to keep personal transactions away from business-related accounts, meaning that what you buy for yourself is for yourself and not owned by the company. Therefore, it can't be considered a company asset. It should not be recorded on any business accounts. For example, if you decide to buy Crocs for yourself, the proper thing to do is not to record the transaction in the accounts of your business, because the product has no business with the company and exists solely for your own purposes. Next, we have the cost principle. The ASPE upholds the traditional cost principle, which requires accountants to record the value of assets at their historical cost price. This basically means that if you buy a pen for the company, then that pen will be recorded at the same price it was purchased at. The continuing or going concern concept is the fundamental principle of accounting, which assumes that during and beyond the next fiscal period, a company will complete its current plans, use its existing assets, and meet its financial obligations. Generally accepted accounting principles are a common set of accounting principles, standards, and procedures that companies must follow when they compile their financial statements. GAAP is meant to ensure a minimum level of consistency in a company's financial statements, which makes it easier for investors to analyze and extract useful information. The Canadian Institute of Chartered Accountants established the standards for Canadian accountants. These standards were made available in the CICA Handbook, which is updated regularly so that it reflects current accounting opinions and decisions. The most significant section of the handbook contains the Canadian GAAP. Originally, the CICA committees were created to oversee Canadian accounting practice, but eventually these committees combined to form one separate governing body called the Accounting Standards Board. The board makes its decisions after consulting with many organizations and like-minded boards, including the IASB. The accounting standards for private enterprises was the result of a developing separate set of guidelines to help private businesses and organizations make the transition to global standards. The main concern was that these private businesses were not listed on stock exchanges, and it would be difficult to continue without international communication. Finally, we have the International Financial Recording Standards. Its purpose was to replace the Canadian GAAP in 2006 and help public Canadian businesses compete and communicate in the global market using international standards.